Welcome to episode 16 of the podcast. We will get straight right into it. Now, tell me this, Romeo, what really makes a stablecoin payment speed? Is it the raw speed of the blockchain? Is it the business model that keeps the issuers afloat? Or is it the privacy of transactions?
Yeah, so that is the question that I will try to answer in today's video. Obviously, the answer isn't any one of them. All three factors
Mhm.
have to be satisfied to some degree. For a stablecoin to become actually payments grade, to truly compete with the likes of, let's say, Swift or Visa, it has to satisfy what I want to call actually the holy trinity of payment readiness. There are three pillars that I want to primarily cover. The one is speed and certainty. The number two is sustainable economics, and number three is enterprise grade privacy. Let me give you a brief introduction to each of them, then I will go
Mhm.
in depth with each of them, right? So, with speed and certainty, what I mean is without subsecond finality, none of it really matters. Every single payment focused chain is right now working towards this objective of getting your payments to settle, uh, process and settle in milliseconds, not seconds, right? That's the pillar one. Pillar two is this is basically the incentive layer where if there is no viable business model for the issuers and the networks, the best technology in the world doesn't matter, like if it's the best technology in the world, it's going to fail, right?
Right.
So the question then becomes is like in the event that interest rates go down on treasury bills or something. So when inevitably interest rates on treasury bills go down, it affects these stablecoin issuers massively, right? So how do they cope with that situation? How do they not collapse, so to speak,
Mhm.
because that is the primary revenue driving force in these stablecoin issuing companies right now. And pillar number three is enterprise grade privacy. Now, this is something that hasn't really been discussed that well enough, or we don't really have a lot to show for this right now. But the thing is, the trust and compliance layer has to be satisfied, has to be properly addressed. No Fortune 500 company will run its payroll or let's say manage its supply chain or its finances in general on a transparent public ledger.
Right.
Security and privacy is key to them, right? So that's where I want to lead our to today's conversation towards. It's fine. Let's get started with finality. What is finality, right? Now, the core concept is finality is obviously simple. It's the guarantee that a confirmed transaction is permanent and irreversible. So once it's gets recorded on the blockchain, it remains there. It cannot be altered, it cannot be changed in any ways, right? But the thing is, not all finality is the same. For example, on the Bitcoin blockchain, it takes about 6 blocks or 60 minutes to get to a near certain finality. And I said near certain, not complete finality, because it's there is always a near zero chance that the Bitcoin or blockchain can be altered. It's hypothetical, it's theoretical, but it's possible. On Ethereum, it takes about 15 minutes to get the to process the
Wait,
transaction.
so you mean if I send, let's say, ERC20 USDT from my wallet to yours, even after you receive it, it's still not final?
Yeah, no, it's not final. Just because I have received the tokens, it is not final, because then we have to understand two two different kinds of finality here. So one is probabilistic finality and one is deterministic
Hmm.
finality. So probabilistic finality is what a proof of work chain like Bitcoin actually works on. It basically means that for a merchant, like if you have sent the payment on Bitcoin blockchain and the merchant has received it, it's probably final. The standard practice is to wait for six transactions, six confirmations on Bitcoin, and then basically you assume that it has been finalized, right? But this inherent uncertainty is what the fundamental problem with the blockchains like Bitcoin is. It's like that when you are interacting with point of sale transactions, or if you're dealing in high frequency B2B payments environment, the payments have to be immediate and the settlement has to be guaranteed instantly. So that's what brings us towards a deterministic finality, which is generally also called like the Byzantine fault tolerance finality. Sorry, like on chains that has that is Byzantine fault tolerant, or proof of stake, so to speak. That's where you see this deterministic finality come into place, where the network's validators will reach a consensus, and then they will be the transaction will be immediate and irreversibly final. There is no waiting period, no added confirmations or nothing like that. So that's where you want to be, right? Now, why is that? Because there is this thing called the reorganization risk, or the reorg. For a merchant, the reorg risk is catastrophic. Imagine what a reorg risk is like in a physical environment. Let's say you are a merchant on a counter.
Mhm.
You have received a payment. You have put it in the cash box. The customer has taken the things and left your store, and then all of a sudden the money disappears from your cash box. That's basically what a reorg risk poses towards it in a payment environment, right?
And
So
wasn't there a reorg in Monero recently?
oh yeah. There was the Monero. What happened with the Monero network is, so there was this like so some validators or a group of validators took control, like 51% control over the Monero network, and then they erased like 18 blocks in I think 36 minutes, and they invalidated about 100 transactions, right? So that means
Yeah.
transactions that were verified and settled got pushed back, and you basically, when you had money in your wallet, you had already paid someone and they
Mhm.
somehow got unpaid. And now what you do, like the Monero network then is basically unstable. Like some merchants even basically said that they have stopped accepting XMR, the Monero token, as payment until the network stabilized. So that's basically exactly what a reorg risk looks like, right? Now, yeah, so one more thing is, like, this is when we are speaking about finality, people think that finality means the transaction going from one wallet to another wallet. The moment that another wallet is reflected to have received the payment is final. That's not the case, as we have just discussed, right? Now, that being said, a blockchain needs to be able to process the transaction first, even before like it's actually settled, within milliseconds, right? So for example, we are seeing different L2 or some L1s as well are doing that right now in different through different technical infrastructures. Like for example, Sui is settling transactions at about 400 milliseconds. You have got Solana with their Tower BFT at proof of history tech stack. They're doing it at about 400 milliseconds as well. Monad is doing it at 800 milliseconds. Say is also, I can say, is actually doing it at less than 400 milliseconds, according to recent reports that I was looking at
Mhm.
just before the podcast. So, I mean, yeah, so all of these chains have definitely, specifically L2s, have definitely figured out how to achieve finality in approximately 400-500 milliseconds. But again, this is we are not really seeing them at massive scale that we expect stablecoins to be able to handle. So we will see how it goes, right? So that was pretty much what pillar one of speed and finality looked like. Now the pillar two that I want to mention is the financial side of things. On the financial side, we need to actually take care of two things. One is the stablecoin issuing company and how they are managing their finances, and the other side of the coin is the companies that are using stablecoins to handle their day-to-day payments or anything regarding their finances. How are they interacting with these blockchains, right? So for example, let me go with the companies that are using stablecoins, right? Let's focus on them first. Even on lightning fast, let's say deterministically final chain, a critical operational barrier is transactional fees, which we call gas fees, right? Now, on
Mhm.
most blockchains, what happens is the gas has to be paid in the network's native token, like for example, ETH on Ethereum, so on Solana. Now, these tokens are inherently volatile. These tokens have market exposure. And they can go up and down at any time. This actually presents obviously a significant user experience issue, right? Because a business that's holding USDC on the Ethereum network, which most
Mhm.
most of them shouldn't do anyways, they have to pay gas on ETH, and then adding to the friction and complexity of a simple payment. So you have to keep to pay the gas. Now, for example, if you're using, there are different layers. Obviously, if you're on base, then you need to have Ethereum on the base chain. If you're on the Arbitrum, then you need to have Ethereum on Arbitrum chain. So it's a completely quagmire of a system that we have right now. Now, for a CFO or a corporate treasury department, this is an accounting nightmare. Now, how do you budget for these transaction costs? Because the transaction costs are not stable. You cannot predict them, like on a quarterly basis or on a monthly basis. It fluctuates widely. Uh, Now, on top of that, there are tax implications, because the asset that you are using to pay transactional fees can be considered as an asset that is accruing value. That's simply going up in value. That means you may have to file taxes on that. So it's quite complicated system right now. And imagine a corporation is spending or managing its finances billions of dollars of flow going through one stablecoin, one blockchain or another. How do you fix these issues? Now, the recent blockchains, specifically the stablecoin focused L1s that we are looking at, like Stripe's Tempo, like USDC's Arc, they have started to issue these these problems. They have started to address these problems, right? So, for example, like native gas. Now, some these blockchains have started these new blockchains have started designing their their infrastructure in a way that you can pay gas fees directly with stablecoins. They have found ways to like utilize protocols like Paymaster's smart contract, which actually came from the Ethereum ERC 4337 standard. It basically allows a user to pay fees in the stablecoin, and then some third party relayer actually takes the stablecoin and pays the ETH back to the network, and that's how the conversion is handled in the background. So these abstractions is what is transforming the model, and what is we are expecting to transform the model in the future. Because on the this gas fee and the chain abstraction side of things, this is very critical for you to onboard clients who will enthusiastically be using stablecoins. Because even if the premise of why you should use a stablecoin makes sense, if you cannot make the how to use stablecoin things extremely easy, nobody's coming to use it, no matter how good it is theoretically. And now on the other side of the coin, we have got the companies that are issuing financial issuing stable coins, and how their finances will look like in near future when interest rates on T-bills are not this high as it is right now. Basically, for the last 2-3 years, this has been the primary business model of major stablecoin issuers like Circle, like Tether, because what has been their business philosophy here? It's basically earn interest on the reserves that's backing their tokens. That's pretty much it. And the reserves are predominantly held in safe, high quality liquid assets like the US Treasury bills. So, and this is a high interest rate environment, which means it's basically a cash cow. So, for example, Tether holds about $93 billion worth of US debt, which delivers them about $5.2 billion in profit every quarter. I think every quarter to half a quarter to 6 months. About, let's say, I don't know the current numbers right off the top of my head, but Tether is making at least $10 to $15 billion in yearly profits just from these treasury bills. Now, this business model is obviously extremely sensitive to central bank monetary policy. What happens when the Fed lowers interest rates again tomorrow? Maybe they lower it by 50 bps, 75 bps, because that's what Trump wants, right? Now, basically, from the reports that I was looking into, each 50 basis point cut from the Fed could lead up to about $600 million in drop in total annual interest rate income for stablecoin issuers. So that's a significant amount.
All right, like so when interest income drops, where do you think the stablecoin companies will look to make the money next?
Yeah, that's what these companies are trying to figure out, right? Because as I was saying, the right now the interest rate is around like 4.2%. Well, not Trump, like Fed Chair Powell did a 25 bps cut,
Mm-hmm.
but that's not nearly enough. So Trump is looking for like 200 bps cut. So we can expect in the next probably year or so, we are going to see at least interest rates around 2.5% at max, not more than that. So that means that's a significant drop in the profit margin of these stablecoin issuers. So now to respond, these issuers like Tether, like USDC, they have to look into other things, not just looking into it. They have to survive. They're looking at they might want to approach or mirror the business model of payment giants like Visa or Mastercard, or they might want to look at how other fintechs are preparing themselves, or how other fintechs are making money, right? So there are obviously a few options that you can do, like you can charge a mint or redeem fees for, like, let's say there's a baseline revenue stream that you can create by charging institutional clients a small fee, let's say about 0.1% or something, to create or redeem large blocks of stablecoin for fiat, let's say just the dollar, right? So that gives you a steady revenue stream. And then you can also do something like a branded stablecoin issuance as a service, where you start providing the underlying technology, the compliance framework, the regulatory licenses for other companies that, like banks, fintechs, or large enterprises that want to issue their own branded stablecoins. Like, for example, if Amazon wants to issue their own Amazon stablecoin, and you as a company can offer them that service. It's basically a white label business to business SaaS model type of thing. I don't know how realistic this is, but I think this is something that some of the companies will start offering, and it may make sense. Then there is obviously like a payment and settlement revenue, which is you are creating dedicated networks of B2B cross-border payments, merchant settlements, and institutional clearing, and you are charging fees for all of these services. You are offering your network, your everything that any other any other stablecoin issuer or any other stablecoin user may need to operate without any issues, let's say. So that's that position that puts you as a direct competitor of something like Swift or corresponding banking. Now, the value proposition here is, I think, compelling because a stablecoin based P2B payments can cost, let's say, $1 to $2 at max, compared to an international wire transfer that can cost up to $40 or more in some cases, right? So that's and then the next thing that I think is a serious consideration for these stablecoin issuers will be card and POS integration and interchange. If they start partnering with, and which they already have, they are already partnering with Visa and Mastercard and other card issuers. So they can enable consumers to spend their stablecoin balances directly at the point of sale. Like if you go to a restaurant and you pay stablecoins, and that can be a lucrative possibility of capturing a percentage of the interchange fee,
Right.
which is typically about like 1.5% to 3.5% of the transactional value. Now, you want to relay the fees or the cost of using stablecoins as little as possible to the customer, to the end customer. You want to make your profit elsewhere. That's where it keeps us. Like if stablecoins issuers or stablecoin companies start charging as much or even more fees than what the corresponding banking or Swift or in general what fiat fintech systems do, then that's definitely a big red flag, right? So you need to find ways where you find your revenue sources anywhere in the middle and not from the customer itself. So that's what I think the issuer should be doing. Now, there are a number of other options that these stablecoin issuers must be exploring, right? And we will have more information on them as they come out. But as of now, the primary moneymaker has been these US Treasury bills and these repos that they are making gigantic interest payments on, right? Yeah, so that was pretty much everything that I have on pillar 2. And then the last thing, which is also the last thing in the flow, is enterprise grade privacy. This is how I see the flow, right? Can you issue payments, settle like processing and settlement within a second? Yes. All right, then it's feasible. Now, if you are issuing the payments, if you are processing or facilitating the payment, can you make money without relying solely on interest payments on treasury bills? If it's yes, then okay, you have passed 2 levels. Now the final and third category, which is, can you ensure or offer privacy, enterprise grade privacy to corporations? Because blockchain payments all blockchain transactions is open to anyone that wants to see, right? You just go to one block scan or another and you can see everything. The thing is, like, enterprises, obviously they cannot conduct sensitive financial operations on public ledger, where their competitors, investors, and general public can see them. And imagine like a company's entire payroll, there are specific amounts to pay to every supplier, the cash flows related to confidential mergers or acquisitions, strategic treasury management movements. You simply cannot let other people see these things. So that makes it a big red flag for them to use any blockchains in particular, because all of them are extremely public, bar some private blockchains. Obviously, this level of transparency in business is simply unfeasible to major corporations. Like, this is critical business intelligence, and it's basically no serious corporate is going to just tell you what they're doing, right? So
Right, but isn't blockchain supposed to be decentralized and transparent? Doesn't that defeat the whole point?
I mean, yeah, that's basically what the premise of a blockchain is, that it has to be decentralized, transparent, and immutable. But the thing here is, when Satoshi first created the blockchain, he didn't really envision large corporations starting to use blockchain to
Right.
do their own payments. Like there was a specific reason why blockchains was created. The Bitcoin blockchain was created the way it is. It was an antithesis of what everything that was wrong with Wall Street, everything that was wrong with the financial system at that time. I don't think he envisioned seeing this merger of traditional finance and decentralized finance. So this is where we come from. We go away from the ideal vision of a blockchain to the practical version of it, where businesses can take advantage of these good features that blockchain has without sacrificing their security, not security, without sacrificing their privacy, and without compromising critical business information, so to say, right? So that's where we are right now. Now the question is, where are we going, or like what do we do with these privacy concerns? There are a few ways that different protocols approach privacy. One is, obviously, you have got your privacy by default, which is how, like, say, like protocol like Monero, that is designed to obscure all transaction details, sender, receiver, amount, like you get nothing out of it. They use, like, there are cryptographic techniques like ring signature, like stealth addresses. That model offers maximum privacy, and that means like the regulators are simply not going to allow you to be able to integrate it in your legal business ventures of any scale, right? Now, then what do you use? Right, there are options like optional privacy. For example, Zcash has this dual address system. They have a T address, which functions like a Bitcoin address, and then they have a shielded Z address, which is a zero knowledge proof address that is specifically designed to provide privacy here. Now you can this gives, basically, if you're an user, whatever you are, an individual or an institutional, you have the flexibility, but it also has some flaws that can weaken your overall privacy of the system. It can create some potential information leaks when funds are moved between shielded and transparent pools, etc., etc. And then there is another kind of privacy protocols, which is they call it programmable privacy, like what protocols like Aztec is doing, right? So what Aztec does is they allow developers to build smart contracts that contain both the public and private functions, and they have created this device which is within a private execution environment that they call PXE, and within this environment, you can submit your proof to a public network for verification and settlement without revealing the underlying confidential data. Now, they do it in a few complicated ways. I'm not a network security engineer or something like that, so I don't have any clue how exactly it works. But it basically, they are trying different ways to mask or basically hide the specific transactional data that gives any intelligence to anyone, right? So Aztec is doing it by, as I said, how they're doing it. There is another platform called Alio. What they do is their computation, and essentially the transaction request gets settled in a local environment. Then you submit the proof to a ZK snark, which is an on-chain feature that I won't go too much into, and the validator simply confirms the proof's validity without seeing the underlying data, like the inputs, outputs, anything. You basically take the ZK snark at face value, and the application and the transaction gets settled. Yeah, so that's two. And as I mentioned in the beginning, Zcash has their Z addresses and T addresses, and Polygon has this thing called Nightfall, which is a base layer in an optimistic rollup, which is generic transparent, but what they do is on top they use like ZK proofs to encrypt the transaction data before publishing it to Ethereum. So that's another way of doing it, right? So this is basically where we are at. One of these, or maybe all of them, will figure out a standard procedure to get rid of revealing unnecessary information that you don't want the public to know, or that you don't want to be available in public places. This is the holy grail of confidentiality and enterprise grade privacy. If we can figure this out, which is, I think this will be the last thing that gets figured out, actually, because you need to actually first figure out the subsecond finality problem. Then And then you come to the privacy side of things, because again, like, privacy is really crucial to corporates, because pretty much everything that they own is, if you're a public company, then it should be publicly available. If you're a private company, then it's available to regulators. So, but if you are not anything like that, maybe if you're just a crypto protocol, or if you're an anonymous organization or an anonymous individual doing small scale transactions, a few $1 million at most, not billions of dollars, then this is not something that you really care about. The subsecond finality will be your primary issue. But that's not what we are discussing here. We want to see stablecoins be stablecoin volumes at trillions of dollars, not a few $1 billion, right? So yeah, that's pretty much where we are. These three problems, once they get solved, we are essentially will be $5 to $10 trillion per year stablecoin volume. Now, obviously, this is not a number coming from an institution or a research group. This is basically coming from me, but this is how I feel about it. So yeah, that's pretty much what the primary issues are.